Welcome to today's event titled Private Equities Pause as part of our Dealmakers series. I'm Kia Kokolacheva, technology and business reporter at Axios, and I'm coming to you today from San Francisco. Welcome to our audiences on Facebook, YouTube, Twitter, LinkedIn, and on Axios.com. Join the conversation today on Twitter with @Axios and hashtag Axios Events. For our first installment of our 2023 Dealmakers series, I'll be joined today by my colleague Dan Primack, and we'll examine the economic headwinds impacting the private equity landscape, tech investing, and lending. Our first guest is managing partner at Tamar Barrow, Seth Barrow, joining us from San Francisco. Hi, Seth. Thanks for joining.
Hi, Kia. Thanks for having me. It's great to be here.
Well, we're going to jump right in and talk about private equity and all the work that you're an expert in. And to get us started, in venture capital world and in startup world right now, everything is about AI and generative AI. Is it the same thing in private equity? Is that what you're living through as well?
It is very hard to have a discussion, even in our world, where the topic doesn't come up, and it's a big area of focus in our portfolio right now. We have a large portfolio of enterprise software companies, mainly selling B2B software, and certainly at every one of those companies, generative AI is a topic that management teams are working on figuring out. It's still very nascent, but there's a lot of really interesting innovation in and around the area, and it's a very active discussion topic at our board meetings, and it's a topic that we talk about quite a bit internally as well. So it's taking up a lot of mind space at the moment.
Do you feel like there's some companies that are sort of doing all of this and having these conversations because they feel like they have to sort of be part of the AI conversation? Or do you think that it's all very authentic to the technologies and the businesses that they're running?
Certainly in our portfolio, it's all very authentic to what we're doing. And today we really view it as an enabling technology. It's a really interesting area to really expand the use cases of the innovation that's already taking place within our portfolio. It's it's an area that we think will create a tremendous amount of efficiency and also empower business users quite a bit. And I think there's a really interesting massive area in and around security and some of the implications from Gen AI that we, are thinking a lot about. We have a very large portfolio of security software companies, so we see it in a very authentic way, and it's still early, and so it's a little unclear, how it all plays out. But we're already seeing some really fascinating early use cases. And we're, excited about the pace at which our portfolio companies have been able to, really wrap products around it and create some really interesting use cases.
We could talk about AI for hours and hours, but in the interest of time, I'm also really curious about talking about the broader market for private equity right now. How do you feel about it? Is it a good time for bargain hunting for you guys as investors? What's your take right now? What are you up to?
Well, we've always had a view that you buy a great software company when you can. And if we look back over time, some of our best investments and best returns in companies that we still hold in our portfolio today were theoretically bought at what might call the peak of the market. So we really always focus on the quality of business that we can buy. We're very focused on quality of revenue, big markets, partnering with great management teams. And we really do that across markets. Obviously, today there's been a change in valuations. The world is now very, very focused on free cash flow and cash generation. And companies that historically have traded just on revenue without a profit mandate or without a clear path to profitability, those valuations are off quite a bit. Our strategy has stayed very, very consistent. And internally, if we can find a great asset to buy that fits our criteria, we'll really try to do that in any market.
But are you finding just more openness, even from publicly traded companies, to have conversations about going private or to sell maybe some assets or some business units that they've acquired or developed? Is this just a more ripe market right now for these conversations?
For us, honestly, I don't think it's, I would consider it a more ripe market. I think we're always very active, really across all market environments. And so I think, the thing that's changed today is that there's just a lot more uncertainty out there. I think it's harder for, some companies to really, understand, what the next year or two might look like. And people are taking a much more conservative view and maybe a more pessimistic view, and perhaps rightly so. But for us, we're always, both active buyers and active sellers.
Hmm. Um, Private equity is inherently also a conversation about credit, and the debt markets right now are not what they used to be. Has that impacted the way that you guys are navigating deal making, or particular deals? Tell me about that.
You're right. I mean, it certainly has made larger M&A more difficult today. There's roughly about 5 billion of available capital in the debt market for cash flow deals, and in our world, when we're looking at companies that maybe aren't quite profitable on day one, that market is more like a few billion of borrowing capacity. So that has changed quite a bit. And more than just available credit, it's just much more expensive than it was a year or two ago. So borrowing costs now are in the teens. All of that is impacting prices, to your point, and also just impacting the scale of opportunity that the industry can currently pursue.
So does that mean that you are not doing certain deals that maybe you would have done 2 years ago?
I think it's harder, and I think it's also it also is will impact price.
Hmm. Hmm. You spend a lot of your time on cybersecurity, and I know that last summer you were quoted in an article about, cybersecurity being kind of still a haven. Do you still feel that way? Do you still think that it's something that, customers are still spending a lot on, and it's kind of a more resilient aspect of tech?
We think cyber continues to be a great space. It's a big market. It's a $170 billion market. It's an enabler of a lot of the digital transformation that underpins also the investment thesis we have in software in general. You need a incredibly solid cyber strategy as you transform your business, which every company in every industry in every region in the world is having to do. What we see today in corporate IT budgets is that cyber is still an area of heavy investment. It's still an area of growth today, and we continue to think that it's going to be very resilient, even in the light of potentially some other areas that might be slowing down as people think about where they need to invest. We don't think it's an area that you can really step back from investment in. And that's what we continue to see in our portfolio. And, we have always been very focused on it. We've been incredibly active in the space. We have a very, very large portfolio of cyber companies. We have good purview into what's going on in that sector, and it's proven to be really resilient in this market.
Is there other areas or sub areas of enterprise tech that are not seeing the same sort of sustained levels of business?
I think any area where people can defer spending right now is an area, as people scrutinize just expenses, and as they worry about their own businesses, that are potentially not going to be benefiting the same way that we see cyber spend benefiting from. And I think that's generally universal at the moment.
Mm-hmm. So what keeps you up at night? We had a recent event where TPG's CEO said that he's more concerned about the whole debt ceiling conversation than AI. So what keeps you up at night as an investor right now in spring 2023?
Finding great opportunities. We always worry about finding the next great opportunity. And we worry about things that are out of our control. And so obviously there's, been a lot going on generally from a macro perspective. We're very, very focused in our portfolio, almost on a weekly basis in terms of what we're seeing around momentum. So we stay very, very close to our companies that way. And, we generally are just concerned about an overall slowdown of business performance.
Fair enough. Well, we're running out of time, but thank you so much, Seth, for being here with us for this conversation today.
Thank you so much.
And next we have a view from the top segment with my colleague Fabrizio Drummond.
Thanks, Kia. Thank you, Cooley, for making this conversation possible. I'm Fabrizio Drummond, Axios Chief Business Officer. I now have the pleasure of hosting a conversation with Al Brown, partner at Cooley. Al, welcome to Axios.
Thank you so much, Fabrizio. It's really, really great to be here.
Well, thanks for joining us. Now, let's dive into this topic of the private equity pause. What are some of the market changes and shifts that you have seen that have contributed to the slowdown in private equity activity that we've seen in this environment?
Sure, and there definitely has been a marked slowdown. Tightening credit markets, just lack of availability of debt, higher interest rates, and then fluctuation in value. We've seen pretty dramatic swings in enterprise value pricing as a multiple of revenue. And frankly, we've seen it swing dramatically in the last year. There are signs of life, though, slight recovery in the public market valuations of late. And then there's approximately $2 trillion in dry powder to deploy from private equity firms.
Well, let's look at the regulatory environment. There have been several regulation shifts in the US, globally. What are some of the regulatory trends that you have seen affect and contribute to the slowdown?
Yeah, the regulatory environment has been a big issue in deal making generally. Globally, we're currently experiencing a period of fairly dramatic deglobalization and generally protectionist policies. In the US in particular, we've seen changes in economic priorities and policy preferences to reduce over-reliance on global supply chains, create more employment within the US, and strengthen antitrust enforcement. The related regulatory authorities have been very active, particularly in the areas of antitrust, trade protection, and securities. This has resulted in less deal certainty, with regulatory outcomes being less predictable, and longer transaction timelines across the board, but particularly in technology and other areas that implicate national security. It also causes more meaningful negotiations on the front end of these deals as deal participants try to address regulatory concerns. A few areas where we've seen it been particularly dramatic is in fintech and health tech, which are generally two attractive areas for PE sponsors. And more broadly speaking, in those businesses at the forefront of monetizing data, particularly risky areas for regulatory review.
And as it relates to other trends that you're spotting and seeing in the market, are there other variables contributing to the slowdown?
Well, we continue to see an emphasis in the private equity space on technology. And last year, approximately a third of the total buyout capital deployed was in the tech space. And as I indicated above, the swings in valuation in the technology sector have really had sort of an impact on deal making generally. As tech firms have focused on, as private equity firms have focused on tech, they continue to need to find ways to partner with management and focus on growth to drive returns. We continue to see that play out in our buyout practice as firms look to partner with high growth companies. Other areas of note, take privates have been active, particularly in the first quarter of 2023. About half of the public to private deals were in the software sector. And then we're still seeing a lot of activity from private debt providers. Private debt providers made up about half of the overall loans in the first quarter, which is a dramatic increase for what we've seen in the past.
Well, this market certainly pushes deal makers to be very creative to help get deals done. What are some of the more creative ways that you've seen in the market as far as deals getting closed?
Sure. We're continuing to see a lot of sponsor-to-sponsor activity as a means of getting deals done. That's a major percentage of the overall deal activity, something like 50% in terms of PE exit value. Given the tight debt markets, buyout funds are increasingly looking at growth equity deals, meaning large minority or bare majority deals, to implement control-like strategies without the need to use leverage. And then in sponsor-backed M&A, we continue to see the use of earnouts and deferred payouts in our M&A transactions to bridge valuation gaps.
Several deal makers are watching this conversation, certainly looking for advice on how to win deals in this competitive environment. What advice do you have for them?
Sure. Wouldn't everyone like to know? So for buyout funds in tech, we think they need to be increasingly focused on successful partnerships with management. This requires them to think a little differently about equity incentives and culture. In terms of equity incentives, I think tech companies have traditionally gone a little deeper into the organization than we might otherwise see with traditional private equity. And in terms of culture, we see from our venture practice that many successful high growth tech businesses operate in a more transparent fashion with lots of perks, which is just not always in line with PE-backed businesses that are a little more focused on operating efficiency. So as sponsors look to partner with those teams, I think those points will be extremely important. And then as always, you win deals by moving quickly, providing deal certainty, and providing the best price.
Excellent. Maybe one closing thought before we go. What are some of the trends that you're going to be watching the second half of this year?
Continue to watch the regulatory environment for sure, just to see what that means for deal makers. And we're not expecting that to change, but it will continue to be an issue that deal makers will have to confront. And then we're going to watch what happens in the tech landscape, particularly with private equity funds. I think we're expecting to see increased take private activity, and I'll be very interested to see how that plays out in 2023 and early 2024.
Perfect, Al. Well, thank you for joining us and for such an insightful conversation.
Thank you, Fabrizio. Really appreciate it.
Thank you. Thank you, Cooley, for making this conversation possible. Dan, over to you.
Thanks, Fabrizio. I'm Dan Primack, business editor at Axios, and our final guest is Murad Al-Hafid, a general partner with Battery Ventures, joining us from Boston. Hey, how you doing?
Hey, Dan, how you been?
Good. Thanks for joining us today. So let's start here. Battery Ventures, as its name implies, began life focused on early stage startups and venture capital, but well over a decade ago, the firm got into buyouts. Can you give me a sense, what's kind of the breakdown of Battery right now in terms of how much the firm is focused on what we'd consider to be private equity compared to what is venture capital, kind of its flagship?
Yeah, thanks. Absolutely. So we were born as a venture capital organization, and then over time, over the years, we grew up to become growth investors. And then actually 2 decades ago, we got into the buyout game. So today, we invest one fund at a time. We're about 1/3 venture capital, 1/3 growth, and 1/3 buyouts, plus or minus. But it's all invested at the same fund.
Why do you do that? Why invest it all out of the same fund? There are obviously other, I'll call them alternative asset firms out there that have dedicated buyout funds, dedicated growth funds, dedicated venture funds.
It's a great question. I would say the short answer is diversification. The longer answer is, and actually the times we're in right now is a perfect example of that. So we are able to come in and out of the strategies. We're able to go into early stage venture when that makes sense. We're able to do a little bit more growth when that market is good. And then we can look into buyouts and late stage strategies when it does make sense. So if you look at what's happening in the market right now, growth equity deals are very slow. So lately, we've been more active on the early stage venture as well as the buyout side of our business, and being able to come in our strategies, be able to adjust with markets, I think is a unique differentiator of our firm right now.
What's the shortest and simplest explanation for why you feel this is a good time, generically speaking, for buyouts, and particularly buyouts of tech companies, which is where Battery focuses?
Yeah, I think it's interesting. The times we're in right now, we've had free capital for a very long period of time, and that's come to an end. And when capital becomes more expensive, people make decisions differently. So when it was cheap and money was free and available, everybody was able to get funded. A lot of money went into the system. A lot of companies were created, maybe more than you'd expect in normal times. And when that all came to a halt, last year, 2 years ago, it's created some interesting opportunities for companies like ours, for our firm, to find dislocation in the market. And so we're able to go into companies that may not have the growth to support IPOs or that kind of outcomes, and be able to provide liquidity, recap those businesses, and own them, do a majority control type transaction, and help them to grow for the support them for the next phase of their growth here. And that's worked out pretty well for us. So we've done that in down markets, we've done that in up markets, and we're pretty busy right now looking at a lot of opportunities that have this profile. If you look at venture capital type firms that have funded those type of companies, they're facing some tough decisions right now. They have companies that have a lot of upside. They may go public. They'll continue to support them. They have companies that are not working, and they'll have some tough decisions to make. And there's a bucket in the middle where they're very nice businesses. They have growth rates that are 20, 30%. That can very well continue to be successful businesses, but may not go public, right? They may not have those outcomes available to them. We find those companies very attractive.
I'm curious, though, within that, in terms of existing portfolio, not in terms of new deals, there's obviously a lot of these companies, if you've got a buyout deal, often there is at least some debt included in that deal. We're obviously seeing rising interest rates, so the cost of that debt for those companies is rising. How much, you talked about venture capitalists, they're doing a lot of job kind of on portfolio management and dealing with stuff they invested in the last couple of years. How much of your time is dealing with existing portfolio, maybe a little bit more, because some of them might have those finance challenges?
Yeah, I mean, the market's changed, right? Debt is very expensive right now, and I think some firms may have lost their ways and have put a lot of debt on those companies, and that's becoming really expensive and very hard to service these days. And I'll tell you, we don't have a lot of that in our portfolio. I think it's happening on the other side of private equity, where deals were getting done with 7, 8, 9 turns of leverage. At the current interest rates, it's really hard to cash flow enough and cover the debt. So a lot of businesses may be cash flow negative. And the beauty of our model is, because we grew up as a venture capital organization and we have growth DNA as well, we tend to look for companies that have some level of organic growth to them. We use private equity strategies, and that's the beauty of this kind of growth buyout type model.
When you say that, are you suggesting that you guys don't put leverage on the companies you buy?
We do, but we don't go very deep. We don't rely on leverage to generate returns. It helps the return profile, but we don't solely rely on leverage to generate returns. We look for organic growth. We look for M&A. We look for operational improvements. We look for expansion through products and geographic, entering new countries as well. So we look at a lot of different things that we implement in those companies, but it's not returns solely generated by debt. And as a result, most of our companies will have leverage that's 4, 5, maybe 6x if we get really deep, but we don't go beyond that. So for the most part, our portfolio is able to service its debt service.
Essentially, when Battery first got into private equity, you guys, obviously you're a tech-focused firm. I remember early on, you guys were kind of on the private equity side, focused on industrial tech primarily, and you guys have kind of gone further in the software stack. Our first guest on this event was Seth Barrow of Tamar, kind of a big tech-focused buyout firm. How often are you guys at Battery running up against the big, and call them big just in terms of size, tech firms, the Vistas, the Thoma Bravos, even KKR and Blackstone, which didn't used to have tech practices, but now do?
Yeah, look, all these funds are, played in a deal size and market that's much further up than where we are. We focus on kind of.
You're not seeing them. So sorry, you're not seeing them come downstream very much.
We don't. Sometimes they'll come down with smaller funds, but it's a second, third type strategy for them. It's not their core focus. We may see them on bigger deals for us. When we step up a little bit, it might be a smaller deal for them, that kind of stuff. But those are not the guys that we're running to day to day.
There was a huge wave in 2020 and 2021 of companies that did go public, and they went public via SPAC. I mean, there were hundreds of them. They seemed to outpace private equity. They seemed to certainly outpace regular IPOs. The vast majority of those are trading well below where they were taken public. A lot of them are even getting threatened with delisting. I'm curious, are you seeing any opportunity out there from a private equity perspective in this giant cohort of de-SPACed companies?
Yeah, no, absolutely. I mean, a lot of these companies should have never been public, right? So SPAC was one way for a lot of companies to access public markets where they didn't have the traditional path to get there, and they've done things that were creative and able to, show forward financials and projections and things like that to get different type of investors to buy into the story. But at the end of the day, not all of them are durable businesses. Many of them, like you said, are trading well below where they went public, and many of them should probably still not be public these days. And so I think you'll see a lot of de-SPACing. You'll see a lot of tech privates for the same reason. A lot of companies went public in 2021 that may not have that durable, high growth, and profitable model that public investors are looking for. And, we've seen a lot of tech privates lately. We'll see more, I think, going forward. In my mind, we'll see many more. And so, de-SPAC or tech privates, I think I'll put them in the same bucket.
That's interesting you say that. Let me ask you about the kind of a third bucket, which is divestitures, particularly public company divestitures of what they would consider, at least what they would call non-core units or non-core businesses. That seems to be an area we're seeing increased activity from. Are you seeing increased activity within your own practice when it comes to carve-outs?
Absolutely. I mean, everything that's happened in 2020, 2021 is being undone for the most part, right? And I'm simplifying it, obviously, but you see a lot of venture-backed companies, they went public, maybe should have not gone public. You see a lot of strategics have made acquisitions and bought companies they maybe should have not bought, or they were not, that are not core to their businesses. And in times like this, when capital is scarce and everybody's going to review, going back and rethinking about their core business and refocusing on that, they'll tend to carve out the things that are maybe less strategic to them, less interesting, that are maybe losing money at a time when investors are looking for more profitable companies and things like that. So absolutely, we're seeing a lot of carve-outs. We're actively looking at carve-outs right now.
Two final quick questions for you, both about debt. So take them quickly. The first one, when it comes to debt in terms of financing your own deals, there's been a lot made about the rise of private credit. Is that where you is Battery, when you are financing one of your deals, is the private credit market where you're tapping more often now?
Yeah, absolutely. The SVB situation did help. We used to do a lot of deals with SVB. That's one source of capital that's maybe still out there, but not in the way that it used to be. And so obviously, it's a good time to be in a private credit. We have a lot of relationships with those funds. We work well with them, and it's definitely one source of capital for us. Yeah.
Final question, a different sort of debt question, which is we've had this debt ceiling issue hanging over us for several weeks, really several months now. Has it had any impact from your perspective on the deal activity that you've seen?
It's hard to draw a direct impact. What I'll say is, this type of negotiations and lack of agreement, creates uncertainty, and uncertainty is not good for business at the end of the day. And so it's hard to draw a very direct line between those two things. But at the end of the day, between that, the war in Ukraine, inflation, bounce back from COVID, you pick whatever, there's a lot of different things going on in the world right now that creates uncertainty, and that's usually not good for business.
Murad, thank you so much for joining us.
Thank you so much, Danny. It was good catching up.
Thank you all for joining us this afternoon for another Axios Dealmakers virtual event that's made us all smarter, faster. For more on what's next for private equity, please sign up for the daily Axios Pro Rata newsletter at axios.com/newsletters or on the Axios app. And to access our exclusive subscriber-only information for professionals who need deeper reporting and analysis around deals and deal making, please sign up for Axios Pro at axiospro.com. Thank you again for joining, and we'll see you soon.